Well, the markets rebounded on Friday to snap its six-day losing streak. However, Dalal Street fell for the second week in a row to record its biggest weekly loss since February. Hello and welcome to Editors Roundtable. Today, we put the spotlight on the changing trends in ownership. We take stock of the BFSI sector and delve deep into the current market trends. I'm Sonia Shenoy, with me Nigel, Prashant, Nimesh. Folks, this was a very tough week, right? I mean, it was all over the place. We have this big geopolitical crisis. There was some recovery through the end of the week, but by and large, you'd have to say the bulls took a backseat this week.
I guess it was more of reality check, Sonia. For a very long time, Indian markets are ignoring the global cues, ignoring a lot of the domestic noise as well, and we're just rallying one way on the upside. I think it was a reality check to the retail investors that, hey, this is a market which can fall as well. You can take some losses as well, right? It cannot be like every week you come and make money and go back taking money. So I guess it was more of a reality check.
That's well put. And actually, I don't know if you guys agree, but one almost got the feeling that a lot of people had stopped verbalizing what they actually felt. Because the market just did not fall, right? It's just going up and up.
True.
Nifty consolidated a little bit in June, July. The mid-cap, small caps never consolidated. They kept going up like a rocket. So even those at some level who had started to say that this is getting a little too much because the market kept going up, right?
Yeah.
So you can't really stand in front of a speeding train. So they just sort of stopped saying it. So I think that's well put, that markets not just go up, they can come down as well.
I'll give you a simple example. Just one example from a retail, psyche point of view. If you talk to a large, broking firm who does a lot of margin funding or the funding book, for the last 2 months, retail investors were not making money month on month on their holdings, but they were still holding on. Nobody was willing to sell. Everybody thought every month, every week, they're only going to make money. So I guess this came as a bit of a reality check. This is a market where there could be a downside as well, and you can lose money as well. So one needs to be a little careful when you're playing, especially in the F&O market.
Since you spoke about playing and since we're in the middle of the Cricket World Cup, let's put it in that context, right? It became so easy. You just had to show up. You don't have to worry what is the pitch, what are the conditions. Show up and you'll make runs. Suddenly now everyone's looking at the pitch. How is the weather? Who to send next to bat? Let's juggle the batting order around. So it's getting a little bit more interesting. But at least for this week, all's well that ends well, right? At least you had 200 points at the end of the week. So.
Absolutely. But in case you missed out on all the weekly action, right, let me just quickly put it into a couple of sentences for you. This week, the market, by the end of the week, slipped for the second straight week. And this is the biggest weekly loss that the market has seen since the month of February. 47 out of 50 Nifty stocks posted losses this week, whether it's Adani Enterprises, HDFC Life, UPL. They were all top losers this week. On the gaining end, names like Axis Bank, post numbers, HCL Tech, Coal India were a few Nifty gainers this week. But all the sectoral indices recorded losses this week, with metals being the top losing index. So the sensex, Nifty and the Nifty Bank fell over 2% each, while the mid-cap index was down about 3% odd. Now, I have with me, Andrew Holland, who's joining us on the show as well. So I wanted to get some first thoughts from him. Andrew, thanks a lot for joining in. If you map the last 3 or 4 times when this world went through a geopolitical crisis, right? And I have the data with me, whether it was the 9/11 attacks in the US in 2001 or the Russia-Ukraine war or even Iraq's invasion of Kuwait, all these geopolitical crises, the 2 years after that, there was a big surge in the market. So, for example, right, in 2001, the year after that, the Nifty went up 40%. Do you think this time around as well that could be the case? And is this a good buying opportunity in that sense for long-term investors?
Yeah, I'm not sure that it's we can put the similarities straight back to some of those events, because when the problems with Israel and Gaza started up, I don't think markets really reacted at all. Oil price hardly moved. If anything, it went down prior to that move by what happened in Israel. So I don't think the markets were taking that into account, and still don't, to my mind. I think the biggest concern has been the bond yields or 10-year bond yields in the US at 5%. I think that's what brought markets down. And couple that with the fact that some of our sectors in reporting season, IT and banking, IT in particular has been very poor, and the commentary has been very poor. But even with the banking sector, where results are fine, the concerns over NIMs continue, and the commentary from the banking CEOs has not really allayed that fears going forward. Everyone thinks maybe one more quarter, but that wasn't coming out from the commentary, and I think that's what impacted the banks as well. So I'm not sure that I would go for that kind of rise of 40%. It'd be very nice, but I'm not sure I would bank on it.
Okay, Andrew, we'll keep coming back to you, but Nimish, what are you picking up? Dealing room, the pulse, the chatter.
So Prashant, as I said, there was a bit of a reality check for the markets this week. So the mid-cap index was down 3%, the small-cap index was down 3% before a brief pullback on Friday. But do remember, the Friday's pullback was largely on from the oversold level. So it's just a technical in nature. We need to see whether this can sustain. Now, there are a couple of headwinds we need to focus on. Of course, there are major global headwinds to watch out for. The earning. The last leg of the earnings typically are not that great, so that needs to be factored in. And the fact that in the month of November and December, there are state elections as well, which will have an impact on the markets. Diwali, November is a big month, right? We have Diwali in the middle of the week. The MSCI review will come in the same week of Diwali. And the fact is we have the World Cup final on the 19th. I only hope that Indian team and the markets don't peak out before we win the finals and before we hit a new high for the market. So hope for that, but I guess this week was a bit of a reality check for investors as well as for traders.
Okay, well, all of us, I mean, that correlation between the Indian team's performance and the market, right? It's uncanny. But Andrew, coming back to you, we had some interesting set of earnings this week. I think what really stood out for me was in the auto space, Maruti's performance, right? Very strong performance coming in, margins at a multi-quarter high, and now it's elevated itself to a new margin band because of selling higher number of SUVs. How are you feeling about this space in general?
No, we've been constructive on the auto sector. I'd like to look a little bit more into those figures, though, to see if there's anything one-off, because the margin expansion is much more than the best kind of optimistic analyst was expecting. So I'd like to see that a little bit more in terms of the detail. But the auto space, continues to look good. Although the reports I'm seeing and the feeling on the ground is that the festival season might not be as good as the market's expecting. So I think that's something they have to watch out for. If there's any disappointment there, because the market's not expecting it. So I would just be a little bit wary about getting too over optimistic on some of the auto numbers just at this point, because we're looking in the rear view mirror rather than looking ahead, and I think there might be a slowdown coming.
Okay, all right. A slowdown coming. Well, a little cautious are we today, Andrew? But we'll turn you around by the end of the show. In the realm of ownership in India, there have been notable shifts in the landscape. Domestic ownership has surged and now reaching fresh highs in the third quarter of FY23. Conversely, FPI ownership has dipped to its lowest point in 10 years. Nimish is here. Nimish, tell us the data.
Prashant, it's a very interesting data, right? And it also shows that there is now stamp of authority of the domestic investors in the Indian market. So let me just go to the wall and explain why I'm saying this. If you look at the data of the change in ownership in India in the third quarter of this year, the domestic ownership has now hit an all-time high of 20%, and that has risen almost 100 basis points in the third quarter. The domestic is up 92 basis points, but the FPI ownership is now at a 10-year low, and that was down nearly 21 basis points in quarter 3. The domestic household, which is the real direct investors, they have also increased their holding in the Indian markets, and that has risen by 20 basis points. Whereas the promoter stake, the promoter holding has gone down and at a record low, which was down 16 basis points, but was at a record low as well. So that's a big change we've seen in the ownership. Look at this: FPIs minus 21, promoters minus 16. The domestic mutual funds, Indian public is where now they have a big stamp of authority on the Indian markets. Now look at what are the FPIs and the DIs have done in the quarter 3 of this year. In terms of major changes, I was just looking at the Morgan Stanley data. This is all Morgan Stanley data. From the 20 institutional holdings, the active positions in the month of September, they've risen the most in ICICI Bank and they've fell the most in HDFC Bank. That's among the top 20 institutional holding stocks. Now, what are the FPIs done? The FPIs have been underweight on the consumer discretionary, industrials, as well as the technology names. And if you look at the DI data, the domestic investors, they've actually reduced their underweight on financials. So now they're warming up in buying into financial stocks. However, they've increased their underweight on technology, consumer discretionary, and industrial. So it basically matches with the data of both FPIs and DIs. Now look at what the FPIs have done in the last 1 year. This was a quarterly data, but if you look at even in the last 1 year, what the FPIs have done, Surprisingly, in the last 1 year, HDFC Bank has been added by the larger FIs. So is the case. Yes Bank is a surprise name there. Dr. Reddy's they've added, Axis Bank they've added, and ABB is the fifth name that they've added in the last 1 year. That is the FPI data. Now, what have they sold in the last 1 year, or where they've reduced stake? In terms of FIs which have reduced stake in the stocks, United Phosphorus stands out, Indus Tower stands out. GAIL is one stock in the PSU where they've sold a bit of stake. IndusInd Bank where they've reduced stake in the last 1 year, and the last name is Infosys in the IT name. So the aggregate data suggests that the domestic investors have put a full authority now on the Indian markets, and their stake is now at 20% at a record high.
Okay, all right, Nimesh, thanks a lot for that. Andrew, you want to come in on that, the kind of ownership change that we've seen in the Indian markets, and how are you feeling about it? What could, the trend look like over the next 6 to 12 months?
No, I mean, it's fantastic in terms of, when I first came to India, we always looked at what the foreign investors are doing, and that would move the market. So that's obviously been a changing kind of narrative over the last year, if not longer. With $2 billion coming in from SIPs, the market's is going to move higher at some point when that money gets put to work. That said, I think we got to that overbought zone, and very quickly, we've gone from that kind of buy on dips to sell on the rise, and that's how quickly the sentiment can change when the market falls. So I think large caps, to my mind, at 17 times forward look reasonable. I still think small and mid caps probably have a little bit more pain left in them if markets were to fall. We've got a weekend coming up, anything can happen, and therefore I'd be a little suspect on the small and mid caps continuing to rally in the very short term. So I think large caps will lead the way.
Okay, well, Andrew, thanks very much. Actually, guys, Akash Prakash in that piece, right? Nimesh, I don't know if you read that piece in Business Standard.
Yeah.
He also highlighted that in every conversation that they had with asset allocators, global fund managers, the strength of the domestics came up again and again. FIs are selling. I mean, we were discussing 7,000 crores of selling, and the market just sort of not holds on. It did sell off, but 7,000 crores is a lot in a
$1 billion and the market's down 200 points. I mean, you take that with both hands, right?
Absolutely. Well, it's a catch-22 situation, though, when it comes to the BFSI sector. While the sector is underperforming, valuations are in favor. Nigel, what is the data?
We briefly had a chat with Pankaj Tibrewal earlier in the week, and he made this point that yes, BFSI is underperforming, but actually valuations are in that favor. So let me go to the wall and discuss that in greater detail. So the BFSI sector on the whole, it appears it's a bit of a catch-22 situation because the stock prices are underperforming, but valuations, well, they appear to be supporting as well. So let's run you through a couple of data points. Off the 52-week highs, the Nifty has lost close to around 5%, but the Nifty Bank is down close to around 8%. We look at the Nifty and we say, hey, it's not trading too expensive. On a forward basis, it's trading at around 17.5 times, depending on what you're looking at. But beneath the surface, if you look at the ex-BFSI universe, it's trading at all-time high in terms of valuations. While for the BFSI universe, well, it's trading at pretty much in line or maybe a little lower than the long-term averages, and maybe at similar levels that we saw pre-COVID as well. And despite the fact that things are looking up. Loan growth, well, mid-teens. If you're looking at capital levels or provisioning buffers as well, they're pretty much quite adequate. And also, if you look at the ROE, ROCs as well, ROAs of the company, the return ratios in short, they're at multi-year highs. And we've seen quite a few managements who joined us on the channel in this week itself. And besides all of that, still valuation-wise, well, the banks are at a big discount in comparison to the ex-BFSI space. So I said, let's focus on two indices. Within the Nifty, if you segregate it between BFSI and ex-BFSI, ex-BFSI is trading at a 34% premium in comparison to BFSI. You'll see that's only for the Nifty. So let's look at the NSE 500. If you look at the premium out there between the ex-BFSI and the BFSI, well, that's reached close to 90%, and we haven't seen that in a very, very long time as well. And, earnings could be tweaked back, particularly for the ex-BFSI. Because you look at it, from June itself, earnings have been tweaked on the downside for IT, chemicals, FMCG. While the lone rangers are BFSI and auto and ancillaries, where you've seen the EPS estimates have actually been marginally up. Short point is, let's just get the valuation chart for you of some of these banking names on a price to earnings or even a price to book basis. They're pretty much in line with the long-term averages. Which way is it going to swing? The stock prices have been under pressure, but valuations are giving them some support which will keep investors enthused as well. Let's get Andrew's view on this. Andrew, what's your view? The BFSI space has been underperforming. Valuations in their favor, return ratios are good, managements, who we have, banking names, they're talking things up. Do you think at some point of time you'd like to start getting in? If yes, what looks good according to you?
So as I said, on the banking sector overall, I think the commentary from the management is has been very lukewarm on the NIMs, and that kind of concerns me. The other concern, which I've spoken about before, is the RBI's own concern on unsecured loans, and I just wonder if they're going to tweak some of the kind of capital requirements for banks, which if they did, that would maybe slow down loan growth. I think maybe the market's trying to maybe price that in case it happens. So I don't think, I mean, as a sector overall, I'm very constructive on the banks. We have to have the banks, but I think in the very short term, the underperformance is telling me something that there's something I'm missing, because by all the results that you've seen, you would expect at least a follow through in terms of the prices moving higher, and they just haven't been doing that. Axis Bank apart, I mean, none of the banks have really followed through since their results because of the commentary from the management.
All right, let's do one thing. Let's take a quick commercial break on that note. But on the other side of the break, we'll take a look at the past rate hikes and the impact that it has had on the market. Stay tuned.